History teaches us powerful, often painful lessons about money. The 1929 stock market crash wasn't just a headline, it was the start of the Great Depression. Imagine stocks losing nearly 90% of their value over 3 long years. Unemployment soared to 25%. The banking system, the bedrock of the economy, completely crumbled, and with it, the life savings of millions. It took a full quarter century for the market just to get back to where it was before the crash. Fast forward to our more recent memory, 2008. The housing bubble burst, triggering the Great Recession. In just 18 months, stocks plummeted 57%. Unemployment hit 10%. The global financial system was on the brink of collapse, saved only by massive government bailouts. Retirement accounts were decimated. That recovery took 5 long years. But what if I told you that what's coming in 2025 is fundamentally different and far more dangerous? We are now facing what some financial historians are calling the everything bubble. This isn't just about stocks or real estate. This time it's stocks, bonds, and real estate, all poised to crash at the same time. When every major asset class falls together, there's nowhere to hide. There are no safe havens. In many ways, today feels a lot like 1928, the year right before the big one, the calm before the storm. But our current situation is actually much more precarious. The safety nets we used after 1929 and 2008 are either gone or broken. The Federal Reserve can't just drop interest rates to 0 to stimulate the economy. They're already near historic lows. They can't just print endless amounts of money. The last time they tried that, it ignited the worst inflation we've seen in 4 decades. And the government can't bail out the system again. Why? Because it's already drowning in over $36 trillion of debt. Right now, almost every major financial indicator is flashing bright red. The consensus among many analysts points to a window for this crash between November 2025 and June 2026. This is not a prediction of a minor correction. This is an alert about an imminent collapse that threatens to destroy more wealth than any event in modern history. This conclusion isn't based on fear or speculation. It's based on cold, hard mathematics. To truly understand why 2025 is so different from past crashes, you have to see the full picture. We are experiencing 3 massive simultaneous bubbles. This has never happened before in history. Let's break down the first one, the stock market bubble. The S&P 500, a key benchmark for the market, is currently trading at a price-to-earnings ratio of about 28. To put that in perspective, its historical average is around 15. It's almost double what's considered normal. We have only seen valuations this stretched twice before in history. The first time was just before the Great Depression in 1929. The second was right before the dot-com crash in 2000, a crash that wiped out nearly 80% of the Nasdaq's value. In both cases, these extreme valuations were followed by a devastating market crash within months. But the danger in 2025 is magnified by something else, extreme concentration risk. Right now, just 7 companies, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, make up roughly 30% of the entire market value of the S&P 500. Think about that. 7 companies are holding up the entire market. If just a few of them start to falter, they could drag the whole system down with them. We haven't seen this level of dependency on a handful of stocks since the big industrial giants propped up the market in 1929, right before it all came crashing down. And today's concentration is arguably even more fragile. Nvidia is the perfect example of the current insanity. It's trading at a price-to-earnings ratio of over 65. That means investors are willing to pay $65 for every single dollar of profit the company makes. Nvidia's market capitalization has soared past $3 trillion. That makes this one company more valuable than the entire stock market of Germany, which is the 4th largest economy in the world. This isn't rational investing. This is pure speculation fueled by the hype around artificial intelligence. It mirrors the internet frenzy of 1999 perfectly. Back then, everyone was absolutely right that the internet would change the world. But they were catastrophically wrong about the short-term valuations of the companies involved. We are seeing the exact same pattern playing out right now with AI. The long-term promise might be real, but the short-term price is a bubble waiting to pop. The second bubble is real estate, which is currently more overvalued than the housing bubble that triggered the 2008 global financial crisis. Looking toward late 2025, home prices sit approximately 50% above their long-term historical trend relative to income and rent. For context, at the peak of the 2008 bubble, homes were only 35% above trend. That means today, housing bubble is roughly 43% larger than the one that nearly destroyed capitalism and required trillions in bailouts. Most people are oblivious to this bubble simply because high prices have become the new normal. But residential real estate is only half the problem. Commercial real estate is in free fall, a slow-motion disaster that will accelerate through 2025 and 2026. Thanks to the permanence of remote work, office vacancy rates across America are staggering. with cities like San Francisco seeing 35% vacancy. These buildings were purchased with mortgages when interest rates were near 3%. As those loans come due, they must be refinanced at rates between 7% and 9%. The buildings simply do not generate enough income to cover triple the interest payments. This guarantees a wave of defaults, bank losses, and cascading failures mirroring the 2008 subprime crisis, but this time centered on commercial properties. The third bubble is what makes the 2025 scenario truly unprecedented: the bond market. Government bonds are traditionally the safe asset investors flee to when stocks crash. In 1929, bonds held their value. In 2008, Treasury bonds rallied as a safe haven. But in 2025, bonds are crashing right alongside stocks. Why? Because the US government has issued an unmanageable amount of debt. Total federal debt has surpassed $36 trillion, which is about 125% of GDP. We haven't seen a ratio this high since the end of World War II. The difference is that after the war, America was the only global economy left standing. Today, we compete with nations holding stronger fundamentals and less debt. The annual interest payment on U.S. debt is now over $1.2 trillion. It is the single largest item in the federal budget, costing more than defense spending or Social Security. When interest payments consume the budget, the government faces only three bad options: drastic spending cuts that cause a recession, massive tax hikes that cause a recession, or printing money to pay the debt, which causes inflation. Every path leads to economic crisis. There are no easy out when your interest payments alone equal the entire GDP of Mexico. This is the reality of the everything bubble. Stocks are at historical extremes seen only before crashes. Real estate is more expensive than in 2008. And bonds, the traditional safety net, are collapsing under the weight of government debt. The parallels between now and 1929 are frighteningly precise. In 1929, valuations hit unprecedented highs. Today, we are at similar levels. Back then, the public believed new technologies like electricity and radio created a new economy where old rules didn't apply. Today, the narrative is that artificial intelligence makes old valuation rules obsolete. In 1929, massive margin debt fueled the boom as everyone leveraged themselves to buy stocks. Today, leverage is everywhere, from retail options trading to credit card-funded investments to corporate stock buybacks using borrowed money. Wealth inequality has also reached 1929 levels, with the top few controlling a massive percentage of the wealth. The economy is now dependent on the spending of the top 10%. If their portfolios crash and they stop spending, consumer demand evaporates. There's a critical way in which 2025 is actually far worse than 1929. Back then, only about 10% of American households owned stocks. When the market crashed, 90% of the population wasn't directly wiping out their savings. Today, nearly 58% of American households own stocks, either directly or through retirement accounts like 401ks. A market crash today immediately devastates the retirement plans of more than half the country. There is no buffer. Furthermore, the banking safety net is an illusion. In 1929, the lack of deposit insurance meant bank failures wiped out savings. We also must consider the Federal Reserve. In 1929, the Fed was young and still had credibility. Today, the Fed has spent 15 years proving its inability to manage the economy. They inflated this massive bubble through years of quantitative easing and near zero interest rates. Then, they hiked rates aggressively, causing inflation while threatening economic stability. They have lost credibility and, crucially, they have exhausted the tools needed to fix the next crisis. The 2008 crisis also provides a grim comparison. That crisis started with subprime mortgages, bad loans packaged and sold to investors. Today, subprime behavior is everywhere. We see unprecedented levels of auto loans with 84-month terms for people with poor credit. Credit card debt is at record highs with average interest rates over 21%. Student loans total $1.77 trillion, much of which will never be repaid. Corporate debt has quintupled since 2008 as companies borrowed cheaply to buy back their own stock. In 2008, leverage was concentrated in housing. Today, it's systemic. The derivatives market is 10 times the size of the global GDP. This interconnection means one failure triggers an unstoppable cascade. In 2008, the Fed had room to cut interest rates from 5.25% to zero to stimulate the economy. They also used quantitative easing, expanding their balance sheet from $800 billion to $4 trillion to inject liquidity. Today, rates are already relatively low, offering little room to cut without reigniting inflation. The Fed's balance sheet is already bloated at over $7 trillion. They are trapped. Print money and destroy the dollar, or don't print and allow a depression. Government bailout capacity is also gone. In 2008, with debt to GDP at a manageable 67%, the government could borrow trillions for bailouts like TARP. Today, with debt at 125% of GDP and trillion-dollar deficits, the government does not have the capacity to borrow another $2 trillion to save failing banks without causing bond markets to revolt and interest rates to spike further. The international environment is also worse, with China facing its own economic crisis and geopolitical tensions, making global cooperation unlikely. The warning signs are already visible. The inverted yield curve, which has accurately predicted every recession since 1950, has been flashing red. Historical data indicates a recession begins 3 to 12 months after the curve returns to normal, placing us directly in the danger zone right now. Consumer debt is saturating the system. Credit card balances have hit record highs, and delinquencies are rising to levels not seen in over a decade. This is critical because consumer spending drives nearly 70% of the U.S. economy. When consumers are maxed out and forced to pay down debt rather than spend, the economy contracts. The commercial real estate crisis is already unfolding. Over $2 trillion in commercial mortgages must be refinanced in the coming years at rates that make the properties financially unviable. Property values in many markets have already dropped 40% to 60%. When these mortgages cannot be refinanced, owners will default, forcing regional banks to realize massive losses that wipe out their capital. We already saw warning signs with the bank failures of early 2023. When the recession hits and defaults surge, dozens more regional banks will fail, quickly exhausting the FDIC insurance fund. The market's reliance on the Magnificent Seven tech stocks creates unprecedented fragility. If a company like Nvidia misses earnings projections or the AI hype fades, it could easily drop 50% or more, dragging the entire index down with it. We are also seeing massive insider selling, a historic precursor to market declines. Executives like Jeff Bezos and Mark Zuckerberg have sold billions of dollars of their own stock. They know when valuations are unsustainable. Simultaneously, Warren Buffett, the most successful investor in history, is hoarding cash at record levels, selling stocks because he cannot find attractive investments. His own market valuation metric is flashing a clear danger signal. Unemployment is beginning to trend upward. The SOM rule, highly accurate at predicting recessions based on unemployment trends, is near its trigger point. Auto loan delinquencies have spiked to their highest rate since 2009, a leading indicator of consumer financial stress. Student loan delinquencies are surging as millions realize they can never repay their debt. Geopolitical risks add another layer of extreme uncertainty, from ongoing conflicts to the threat of supply chain disruptions that could trigger stagflation, the nightmare combination of inflation and recession. The crash will not begin with a single obvious event. It will start with a trigger, an earnings miss, a bank failure that seems manageable. But because the system is so fragile, it will start an unstoppable cascade. Algorithmic trading will instantly sell off key tech stocks, triggering margin calls. Forced selling will drive prices lower, triggering more margin calls in a downward spiral. Unlike previous crises, this time the flight to safety will fail. As investors rush to bonds, the government will need to sell trillions more bonds to cover deficits. This supply glut, combined with panic selling, will spike interest rates, increasing the government's debt service costs and creating a doom loop that ends in default or currency debasement. The housing market will freeze or rise meaningfully, with prices eventually dropping 40% to 50% in overvalued areas, leaving millions underwater on their mortgages. Bank failures will incite panic and bank runs, forcing the government to print money and destroy the currency's value to cover deposits. Unemployment could skyrocket to 15% within a year. The Fed will face an impossible choice: fight the crash by printing money and reigniting hyperinflation, or let the depression play out. There is no middle ground because their tools are exhausted. The impact will be devastating. Retirement accounts will be halved, forcing older Americans to keep working or lock in unrecoverable losses. Recovery will not be quick, like in 2008. It could take decades, similar to Japan's 34-year recovery after its 1990 crash. A generation of young workers will face a brutal job market, scarring their lifetime earnings potential. Small businesses will be decimated, further consolidating corporate power. Political instability will inevitably follow economic collapse as desperate populations seek radical solutions. 2025 is worse than 1929 and 2008 combined, because we face the asset bubbles of the former, the debt bubbles of the latter, plus a new government debt bubble, all simultaneously. The tools used in previous crises are gone. The mathematics of unpayable debt and overvalued assets guarantee a correction of shocking scale. The everything bubble will live up to its name. The crash is coming. The only question is if you will be prepared.